I want to talk to you about what is happening in the world right now, not because I believe in reacting to news, not because I think the day-to-day events of geopolitics should change how you think about the businesses you own, and not because I want to add my voice to the chorus of panic that is filling every screen and every conversation right now. I want to talk about it because what is happening in the markets today, as tensions in the Middle East escalate and as the headlines about Iran fill the financial media with the language of catastrophe and collapse, is not new, it is not unprecedented, it is not the end of anything, it is something I have seen before and something I watched intelligent people survive and profit from, and something I watched frightened people turn into permanent financial disasters through decisions that had nothing to do with the underlying reality of the businesses they owned. Let me tell you what I actually see when I look at a market that is falling. Because the world feels dangerous. I see a store having a sale, and I want to explain that statement so completely and so specifically that the next time you open your portfolio and see red across every position and feel the physical sensation of anxiety rising in your chest, you will have a different thought available to you than the one the financial media is trying to put there. What is actually happening when a market crashes? Let me be precise about the mechanics of what a market crash actually is, because most people who experience one have never had it explained to them at this level. When the news about the Iran situation broke and markets began to fall, the businesses listed on those markets did not change, not one of them. The coffee shops were still making coffee. The pharmaceutical companies were still manufacturing and distributing medicine. The technology businesses were still processing millions of transactions per second. The consumer companies were still selling products to the same customers who needed those products the day before the headline appeared. Nothing about the economic reality of those businesses changed in the hours and days following the news. What changed was the price that buyers were willing to pay for ownership stakes in those businesses. And what drove that change was not analysis. It was fear. Collective, simultaneous fear transmitted through financial markets at the speed of information. When fear enters a market, it does not distribute itself rationally across businesses based on how much each business is genuinely affected by the feared event. It distributes itself indiscriminately. Businesses with no exposure to the Middle East fell alongside businesses with genuine supply chain exposure. Businesses whose revenues are entirely domestic fell alongside businesses with significant international operations in affected regions. Businesses sitting on fortress balance sheets with 10 years of consistent earnings fell alongside genuinely fragile businesses that deserved the repricing. This indiscriminate falling is not a reflection of changed business value. It is a reflection of changed human emotion. And here is the single most important truth about the relationship between human emotion and business value: they always eventually separate. The emotion resolves, the fear subsides, the headlines that felt permanent reveal themselves as temporary, and the prices of genuinely good businesses migrate back toward the value that the underlying economics of those businesses have been producing all along. This has happened after every war, every geopolitical crisis, every market panic of the last century, without a single exception, not always quickly, not always smoothly, but always. I was 25 years old in 1919. I want to tell you about the market I entered as a young man because it is relevant to what you are watching right now. When I arrived on Wall Street, the world was recovering from the First World War. The Spanish flu had killed more people than the war itself. There was political instability across Europe. There were genuine fears about the future of the global economic order. The market was not calm. Sensible people had genuine reasons to be frightened, and yet the businesses that were well managed and financially sound and selling products and services that the world genuinely needed continued to generate value for their owners through that entire period of uncertainty. Then, in 1929, the market crashed catastrophically. People who had borrowed to invest lost everything. People who had invested money they actually needed and had no cash reserves were forced to sell at the worst possible prices. But the people who had invested in genuinely good businesses with their own capital and had sufficient cash reserves to not need that capital for several years did not permanently lose anything. They temporarily watched their portfolio values decline, and then over the years that followed, they watched those values recover and exceed their previous levels. Then there was World War II, then the Korean War, then the Cuban Missile Crisis, when people genuinely believed nuclear war was possible. Then the oil crisis of 1973, then the inflation crisis of the late 1970s, then the savings and loan crisis, then the Gulf War, then the Russian default and the long-term capital management collapse, then the dot-com crash, then the September 11th attacks, then the Iraq War, then the financial crisis of 2008, then the European debt crisis, then the pandemic. And now every single one of those events produced headlines that sounded like the end of something. Every single one of them produced market declines that felt permanent while they were happening. Every single one of them resolved. Every single one of them proved to be an opportunity for the investor who had prepared correctly and who understood what they were actually looking at. I am not trivializing the human cost of geopolitical conflict. The events in Iran and the surrounding region are genuinely serious, and the human suffering they produce is real and matters enormously. I am saying something specific about markets price fear, and markets price recovery, and the investor who can distinguish between the price of fear and the price of genuine permanent business destruction is the investor who builds wealth across cycles rather than having it destroyed by them. What Benjamin Graham actually did during market crises. I want to be specific about what my framework directed me to do during periods of market panic, because watching from the outside and acting from the inside are entirely different experiences, and I want you to understand what the inside felt like during market declines. I did not feel clever. I did not feel calm in the way the word is usually used. I felt the same biological signals of threat that everyone around me felt. My body registered the falling prices as a danger signal, the same way everyone else's did. The difference was not that I did not feel the fear. The difference was that I had a written framework that told me what the fear meant and what to do with it, and what the framework told me consistently was this. When a financially strong business with a long record of consistent earnings and a solid balance sheet falls in price because of market-wide fear, rather than business-specific deterioration, the correct response is not to sell. The correct response is to look more carefully. And if the analysis confirms the thesis to buy more, this feels counterintuitive because it contradicts the biological instruction of the fear response. The fear response says, run with the herd. The framework says the herd is creating a sale, and the sale is not permanent. The businesses that were worth $100 yesterday are not worth $65 today because of a geopolitical headline. They are being offered at $65 by frightened sellers to whoever has the cash and the conviction to act as a buyer. I was that buyer during multiple market crises across my career, not in every case, and not always with perfect timing, but consistently enough and with enough analytical discipline behind each decision that the pattern of buying during fear and holding through recovery produced results that the investor who sold during the fear and bought back during the recovery could never match. The Iran situation specifically and what the intelligent framework says about it, let me address the current situation directly, because I believe you deserve specificity. Not only philosophy, geopolitical events of this kind have a historical pattern that is remarkably consistent when conflict escalates in an oil-producing region. Energy prices move sharply. Energy price movements affect the costs of businesses that depend on energy as an input and the revenues of businesses that produce energy. There are genuine second-order effects across supply chains and trade routes and currency valuations. These effects are real, and they affect the near-term earnings of specific businesses in specific ways. But here is what history shows about the duration and permanence of these effects. They are almost always shorter in duration than the market prices them to be. At the moment of peak fear, markets in moments of crisis do not price the most likely outcome. They price a combination of the most likely outcome and the worst possible outcome, weighted heavily toward the worst possible outcome. Because fear is not a rational probability calculator. It is a survival mechanism that has evolved to treat dangerous uncertainty as maximum danger. This means that the market decline you are watching right now almost certainly contains within it a significant component that is not pricing a realistic assessment of the economic consequences of the current conflict. It is pricing worst-case fear, and worst-case fear applied to genuinely good businesses creates the exact conditions my framework was designed to identify and act on the businesses in your portfolio that have fallen 20 or 30% in the last weeks, and that have no direct operational exposure to the affected region, and that have the financial strength to survive even an extended period of economic difficulty. Those businesses are not worth 20 or 30% less than they were before the headlines. They are being offered to you at a 20 or 30% discount by sellers whose fear is making them unable to think about anything except the immediate sensation of loss. The question the framework asks is not, is the world dangerous right now? The world is always dangerous in one way or another. The question is this specific business genuinely worth less than the price being offered? Or is this price a product of fear that the underlying economics of the business do not justify? Answer that question with your analysis, not with your emotion, and you will know what to do. What separates the investor who profits from the one who is destroyed? I want to be direct about the conditions that determine which side of this crisis you end up on, because not everyone who holds through a market crisis profits from it. Some people hold through a crisis, and the crisis turns out to have permanently impaired the businesses they own and they should have sold, and some people do not hold through a crisis, not because their businesses were permanently impaired, but because they were not in a position to hold the difference between these groups. Is not intelligence, it is preparation. The investor who profits from a market crisis is almost always the investor who did three things before the crisis arrived. They built an emergency fund that means their actual financial life does not depend on their portfolio. They eliminated or minimized high-interest debt that could force selling, and they invested only money they genuinely do not need for the next 5 to 10 years. If those three conditions are met, then a market crisis is not a threat to your financial life. It is a repricing event in assets you own that will resolve over time. If those three conditions are not met, then a market crisis is genuinely dangerous. Not because the businesses in your portfolio have been permanently destroyed, but because your personal financial situation may force you to sell them at exactly the wrong moment. This is the lesson of 1929 applied to 2026. The people who were destroyed in 1929 were not destroyed because they owned bad businesses. Many of them owned excellent businesses. They were destroyed because they owned those businesses with borrowed money or without adequate cash reserves, and when the crisis arrived they had no choice but to sell preparation before the crisis is worth more than analysis during it. I have said this in different forms throughout this series: the emergency fund, the debt elimination, the written investment policy. These are not secondary concerns that you address after you have built your portfolio. They are the foundation that determines whether your portfolio survives the events that the market will inevitably deliver to it. The practical question of what to do right now. I want to give you something specific and actionable, because philosophy during a market decline is only valuable if it translates into behavior. Here is what I would do right now. If I were in your position, the first thing is to do nothing with your existing portfolio for at least 48 hours. Not because 48 hours will resolve anything about the geopolitical situation, but because 48 hours creates the distance between the initial emotional response and the analytical response that good decisions require. Every decision made in the first 24 hours of a market panic is made under conditions that are unfavorable to good thinking. Wait. The second thing is to look at your existing holdings, not at their prices, but at their financial statements. For each business you own, ask the one question that actually matters: has anything changed about this business's ability to generate earnings for its owners over the next 5 to 10 years that is not already reflected in my original thesis? If the answer is no, the price decline is noise and the correct response is to hold. If the answer is yes, you have found a genuine thesis. Breaking event and selling may be appropriate, but the answer to that question must come from the financial reality of the business, not from the price movement and not from the headlines. The third thing is to look at your cash position. If you have been maintaining an adequate emergency fund, And if you have investable cash beyond that emergency fund, this is the environment where that cash becomes valuable. The businesses that were on your list as genuinely good but previously too expensive may now be approaching the prices that your analysis suggested would represent genuine value. Not because the businesses have changed, because the fear of the crowd has temporarily moved the price closer to or below that value. Make a list of those businesses and the prices at which your analysis suggests they represent genuine value, then watch and be ready. The fourth thing is to close the financial media, not forever, and not because the information is worthless, but because right now the information being produced by the financial media is not helping you think clearly about the value of the businesses you own. It is designed to maintain your anxiety, because anxious people stay engaged with media, and engaged people generate the advertising revenue that funds the media. The information you need to make good decisions right now is in financial statements, not in headlines. Read the statements, close the headlines. Your assignment here is what I want you to do today. Take your 10 largest holdings and for each one, write down 2 things. The first is whether the business has any direct operational exposure to the current geopolitical situation, genuine supply chain disruption, genuine revenue exposure in affected markets, genuine cost exposure through energy prices. The second is whether the financial strength of the business, its cash position, its debt levels, its earnings, consistency gives it the ability to navigate a 12 to 24-month period of economic difficulty without permanent impairment. Businesses with high direct exposure and low financial strength deserve careful reconsideration. Businesses with low direct exposure and high financial strength are almost certainly being offered to you at prices your original analysis did not anticipate and may not see again for years. Write down the prices at which each of your high-quality, low-exposure holdings would represent the kind of value that your framework says is worth acting on decisively. Then be patient and be ready. The market will do what markets always do during geopolitical crises. It will price the worst possible outcome, and then the worst possible outcome will fail to fully materialize as it almost always does, and the prices will recover. And the investor who was prepared and patient and analytical will look back at this moment not as the disaster the headlines said it was, but as the opportunity that periods of maximum fear always create for the investor who refuses to be swept along by the crowd. The bottom line, market crashes are not disasters for the prepared investor. They are sales. The businesses you own today are the same businesses they were before. The Iran headlines appeared, their employees, their products, their customers, their competitive advantages, their long-term earnings. Potential did not change when the news broke. What changed is the price that frightened sellers are willing to accept for them. And frightened sellers accepting lower prices is not a disaster for the buyer who has prepared correctly. It is the moment that the patient investor has been building toward through every quiet period of accumulation that preceded it. The war in the market is not between the bulls and the bears. It is between fear and analysis analysis always wins eventually. Not always immediately, not always comfortably, but always eventually. Prepare your finances. Survive the decline. Hold the businesses whose underlying value your analysis confirms, and let the market do what it has done after every crisis in its history come back. That is how the intelligent investor thinks. Thank you.